Weekly broadcast. My name is Lee Honish. I represent Monster Marketing, digital marketing, professional coaching, consulting, everything. Go to honish.com, learn more. We are here to discuss distressed properties. It has turned into a little bit more of a broadcast about general coaching in general and consulting for those around us. I am joined, as always, by broker, mitigator, and all-around nifty guy, David Bartels. How are you today,
Good
David?
morning.
David, as always, tell us a little bit about Home Loan Advocates.
Well, Home Loan Advocates spends a little time negotiating with banks. We do a lot of short sales over here. You got a problem short sale, we can probably help you. We also help in homeowners fight off foreclosures, coaching them on loan modifications, and in general, helping real estate agents and investors put together really complicated transactions and turn dead deals into income. And you could reach me at 805-413-8000 or David at homeloanadvocates.com.
As we normally do on this, I like to pull stories throughout the week that I think would be interesting to each and every one of you. This one in particular coming to us from lovely Housing Wire. Eisman, famed for shorting subprime, explains why he's betting against Zillow. For those of you who don't know, Steve Eisman, the Neuberger Berman portfolio manager who famously profited during the financial crisis by betting against subprime mortgages, criticized Zillow's business model in a CNBC interview last week, David. Eisman disclosed he's shorting the stock, which means he's making money if the shares decline. Eisman's lucrative short-selling position a decade ago were chronicled in Michael Lewis's best-selling The Big Short, and was depicted by Steve Carell in the 2015 movie, and a great movie. We've discussed it many times. Here's what he had to say. Zillow has one of the most flawed business models I've seen in a very, very long time. The part of it I find most problematic is what they call, I believe, their iHome business, their internet buying business, where they actually go out and buy homes and flip them. I actually think the company doesn't understand the real risks of this business, which are massive. There are thousands of mini markets all over the United States. They're all local. They're all extremely different. They're all incredibly different risks. This is a capital intensive business. I know only one thing for certain: between now and 5 years from now, assuming the company has some level of success, there will be massive problems that will uncover that they will uncover. I'm sure there'll be write-downs. I'm sure there will be impairments, and I'm convinced the investor base doesn't have a clue about what this business is really all about. I would love to hear your feedback on this, David. What do you think about the iHome buying program? And we're big fans of Steve Eisman. We're big fans of The Big Short. So I'd love to hear your feedback.
Okay, so I think iBuyer is here to stay. I think that there's a lot of consumers who are interested in what they perceive as an easy way to sell a house. It's not that different than trading your car in versus putting an ads in Craigslist and trying to sell it. I know if I do the extra work and I show the car, and I could probably pick up an extra couple of grand for the house, or I can trade it in at the dealership. I know I'm going to take $2,000-3,000 less for it, but I'm going to drive away in my new car and I don't have to fuss with it anymore. I think iBuyers are going to be here for a certain percentage of the population. I'm not sure Zillow is any good at executing the iBuyer concept. Based on some of the preliminary numbers, they're going back in the over $100 million negative on iBuyer so far, and I think that regarding Zillow in general, these guys are firmly entrenched in the real estate business. Their model is changing right now. They are moving to their premium agents are going to start paying a referral fee. So you're going to start seeing the lead gen converting to referral fee versus, paying $2,000 a month for a zip code to get leads that they give to 5 other agents. And they seem to be acknowledging that their business model is flawed based on this transition. And the other big transition that you see is that they're actually cultivating the leads, they're tracking them down, and then they're turning over more solid leads, already pre-vetted leads to agents at this point, because agents are complaining about the quality of leads that they're getting. So there's lots of changes coming to Zillow, but they're not going away. I'm not sure about I don't know about the mechanics of shorting it or not shorting it, but they're going to be here a long time. They are no danger of running out of money.
Yeah, I completely agree with that. But it's interesting that he takes that perspective based on a risky solution of, in his mind, I think he sees them as house flippers or.
Yeah, well, the iBuyer concept, it comes with risk. I mean, a 5% margin of error on a $500,000 house is $25,000. There's, these guys are working in some volume. So you got to be careful. I mean, I'm going to go out on a limb and say the people who are making decisions to buy these houses and evaluate the opportunity are probably not that experienced. I mean, they might be 25 years old, fresh out of college, and they, are more adept at a keyboard than a screwdriver. So,
Yep.
I don't know how they're doing it, but I hear they're paying a premium to get their foot in the door, and that spells and smells like trouble.
Yeah, it does. But I mean, from an internet perspective, right? And I have to say this, I'm not saying it in defense of the Zillow program. I think a lot of what they do is flawed. I think the overusing of leads is flawed. I think using the money on the backs of real estate agents to, if they had it their way, get rid of real estate agents is also somewhat comical. But I do understand the necessity from a business standpoint of investing back into it and taking the risk and possibly eating money to get the program established. I mean, from their point of view, it's investing into a possible long-term solution, I would guess.
Zillow is not afraid to lose $200-300 million. I mean, think about it. When they were born in the internet boom, and I don't know how long, they might have went 10 or 15 years without making a profit. Why they built the infrastructure. So they have no problem looking way out into the horizon to see what the opportunity looks like. They are not short-term thinkers. They can't, I mean, on the other hand, I read somewhere they're still generating over $900 million in fees from agents paying for leads on their site. 900 million. So they're not going to eschew that model either. What they're trying to do is that they think that they can get these agents to pay them a referral fee, and they think that they're going to, which is what a lot of other lead gen sites are doing, and they're testing it in Phoenix and Atlanta right now, or getting ready to. And I think that if it's successful there, I think that you're going to see it rolled out across the country. You have to buy your territory, and then it's you pay for performance, and they will cut you if you have lousy conversion rates.
Now, did I see this correctly? Is it Purplebricks that's pulling back?
Purplebricks is done. They'll be out of there. Stopped doing business other than the deals that were in escrow, and they'll be completely gone from the United States by the end of the year.
Interesting.
You'll notice
Flawed
that you
model.
see no more advertising.
Yeah. Flawed model. Couple questions from the board. David wrote, I'm seeing an increase in auto loan defaults and BK filings, but the market is still hot in Northern California. What are your thoughts, and how do you see the market for the last 2 quarters and next year? So my perspective first, I've been saying it, I've been screaming it, ever since the 90-day DQ on what we calculated as 10% of all people who have a car loan. I don't know. There's obviously a cash flow problem. Obviously, we are still a society pushing day-to-day homes. I have to imagine home sales being as high as they are, pushing people to the brink. I don't know how long they can keep pushing down the numbers and modifying people before it becomes a substantial problem. That's my greatest take. I feel like that this is, I don't see a big burst. I don't see a big drop anymore, but I definitely do see a point where the Fed has to raise its rate. Obviously, you can't do money for free forever. And I also, and I've been saying it all year, that I truly believe for the economy and the health of the country, you have to bring the rate up on the Fed. You have to slow everything down. You have to bring prices down. I think people are pushed to the limit. And what my greatest fear is you keep pushing it back and pushing it back and pushing it back. You are giving the opportunity to create a bubble at some point. Your feedback, David?
Well, I don't know what the forecast is going to be. I mean, we've had a pullback, and you know, my feeling is that the market's going to stay flat to down or flat to up. I think that we're seeing a stall in the market again, which can be attributed to the Fed kind of, you know, communicating that they're going to keep reducing interest rates. And I think buyers, even though the Fed rate is not really tied to mortgage rates, I think there are a lot of buyers who think two things, and that is rates are coming down and prices are coming down. And so we're seeing a lot of sitting on the sidelines again, like we did last November, or I'm sorry, November of 2017, when the stall really started before, and it lasted almost 18 months. This is probably more short-lived, but we are seeing buyer appetite is pulled back a little, and that could result in lower prices. There are a lot of sellers on the market right now that need to sell by the end of the summer, and we're starting to see a lot more aggressive price cutting as the people who have to sell are getting aggressive. The people who don't have to sell, their properties are going to come off the market. And between the low rates and the discounts, that should probably get buyers a little more active. And then, but I don't see the market climbing or dropping more than a couple of percent either direction. And a lot of what happens depends on the markets you're in. I don't know anything about Northern California to speak of, other than the house prices are a lot higher than they are here. But I think we're looking at a pretty flat, stable, more balanced market over the coming 6 to 8 months.
I'll pose this question to you while people load up questions. I got an email from I guess, independent loan broker or private trust money, but it was basically a 30% down, no with gift money at 3.75. Like the rate was astronomically low. From your perspective as a broker, how much is private money affecting the current market and giving people the ability to buy?
I don't think that it's really having an impact on the traditional retail buyer. I think that, I mean, maybe there's a small percentage of marginal buyers that are doing, but even these, they're, it's no bargain to buy a house at 7% interest rate. I mean, that's right. It's a high price to pay. So when, the only people I know that are really doing it are people who think that they're going to be able to get out of that loan here within a year or two, or people who have a very short-term focus on the asset. In other words, they're a fix and flip kind of thing. So I think that's really that's where most of the money is. It's mostly non-owner occupied stuff, and there are some exceptions, but interest rate's a big penalty to them. So I don't know that it makes a big difference.
There was one last story, and I don't think we covered it in previous weeks that I wanted to bring up now that we're back and going. So the most at-risk loans out there on the market right now are FHA. They have the highest default rate because they just changed the guidelines to make them more desirable. There was legislation suggested, it has not passed, and I've only seen it since the initial story, where they were looking to make special exceptions on FHA loans that went into default on a government level. And I would just love to hear your feedback on on even the concept.
On the exceptions for FHA loans?
Yeah, that there would be special circumstances for those that have FHA loans who default. We can't. I believe it was Maxine Waters who brought it up, who proposed the legislation, but FHA loans were going to get special exceptions when they default to help them cure and modify and keep them in their homes.
I don't know really much about it. So listen, it's FHA is already hard to deal with. I know on the, I find it interesting that so the program that was designed to help more people buy homes happens to be the toughest program they'll work with to help them keep it. So an FH loan is very difficult to get a loan modification on, and they're very difficult to short sale relative to conventional loans. And so maybe that's the problem she's trying to cure. So if that's what it is, and that's what it sounds like it might be, it can only be good for homeowners, but their redefault rate is likely to be as higher than conventional mortgages are too. So I don't know if it makes a difference, but I like it from our business perspective because we'll be able to help more homeowners.
Yeah, I agree on that level. I wonder just more about government intervention into the housing market on that scale, creating actual legislation or creating actual anything in regards California. Well, we're in California where it's already so pro homeowner, pro renter as it is. I was walking out of a theater or something the other day, and somebody said that they were trying to pass a bill, or they wanted signatures for a bill to keep renters. Oh, it was another rent control. Like they wanted even more rent control within Southern Cal. It was for the Southern California area. I think we have too much in California. I don't know. I can't speak for the rest of the country, but from your perspective, working on defaults and things of that nature, we just seem very government heavy handed pro renter. And maybe this is the banker in me, David, but I don't think it's really fair for the people who lent the money.
Well, some of the pro renter stuff is kind of getting tougher. Some of the legislation they're trying to put, it's not going to be fair to the investor. So they're making it easier to rent. They're trying to control rents, which really is going to depreciate the value of the asset and disincent people from owning rental properties. And and this is in a state where they're saying by 2025, 50% of single family homes will be non-owner occupied. So yeah, I mean, it's pretty pro. I don't think it's good for anybody for them to be tinkering with it. I'm all for less regulation. I know the current administration has cut a lot of the regulation and tried to do more. It's a big bureaucratic machine, and I'm a capitalist, so I believe in the free markets and go from there. So my opinion is going to line up across those lines.
Mine as well. And lastly, while we're on the topic, just sort of covering news and notes, did you see the Dow this morning?
Yeah, my wife's in the stock market business. She leaves the house about 5:15 a.m. And she said, "Oh, it's going to be a tumultuous day in the market." I said, "Why?" And she said, "The 210 is inverted." I needed her to clarify what she meant. And basically, for the first time in history, the 2-year bond, the short-term bond, is yielding more than the 10-year bond. So in the 10-year is what mortgages are based on. And so that inverted yield curve basically is creating fear in the marketplace. And last I heard, it was down over 500 points. I don't know what it is now, but
At one point it was at 750. I'm actually putting it up right now. At
yeah,
one point it was up to 750.
So that's what's happening. So it is officially, you can officially make a 2-year investment and yield a better return than a 10-year investment. So, theoretically, the longer the term, the higher the yield; the shorter the term, the lower the yield. And now the market's that has shifted. That is typically the market. The market regards that as a sign of a recession. Okay,
Yes.
which is why the stock market is tanking because they see it's an indicator of a recession, and a decline in housing is one of the areas that are affected, though there are a lot of factors that suggest that it's probably not going to happen right now. So
There you go, Dave. Give out your
so I
information.
called it right there. See,
You did. Oh no, you nailed it. I got it on the screen. You nailed it on the button. Straight up, everybody's talking about it's all recession talk.
Yeah.
All the bells are going off, and the market's tanking. And Steve Eisman probably at this moment is collecting money as Zillow's stock is dropping.
Well, we'll see. Zillow's gonna. I don't know if Zillow does better when the market's good or the market is bad. So I mean, part of me thinks that if the market is bad, that and agents become desperate, they spend more money, when their revenue is declining, and less money when their revenue is going up. I don't know if that's true or not. That's just a thought.
Give out your information one more time, David.
David Bartels, Home Loan Advocates. I see it on the screen, 805-413-8000. And you can obviously go to homeloanadvocates.com to get more information.
If you'd like to join this group or find out about marketing solutions, go to honish.com. I cover a wide range. Monster Marketing is distressed property. Just click on the Monster Marketing link. If you'd like to find out about digital or online marketing that is for real, not some phony BS ad thing that most people are trying to push, go ahead and click on that. Also, private consulting, private coaching, all of that. Just go to honish.com, scroll down, click on the free one-on-one with me. I will be notified immediately, and I will get a hold of you.